new.
Okay, so California's FAIR Plan has now been given the go-ahead to charge private insurers $1 billion to help cover the shortfalls in the premiums that it collected. The state insurer of last resort works on a cash-in, cash-out basis, and it's just exhausted its reserves. The number of properties the FAIR Plan covers in California has just soared as private insurers work to lower their exposure in the state, in large part because you had the state insurance department that would not permit the carriers to charge enough to cover the risk. And so now you have State Farm, Farmers, Allstate, Travelers, Chubb, and lots of other companies that were working actively to lower their risk, to lower their exposure in California, and they're going to end up paying for the losses anyway when they weren't even collecting the premiums. But that is permitted by state law, and then they can turn around and pass on half of that to consumers. Insurers have been declaring their early estimates on wildfire losses, but they're using an asterisk, excluding what they're going to have to pay for in terms of the FAIR Plan. That assessment gets divvied up according to market share. And with reliable estimates of insured losses coming in anywhere from $40 billion to $50 billion, which, by the way, would make it like the second worst natural catastrophe in history in the first quarter. I think this really could be just the beginning of the assessments on insurers from the FAIR Plan. But think about it, the smaller insurers that said, we can't face the risk that we're going to have $300 million to pay for the FAIR Plan, so we're going to be out. If you were operating in California in the last 2 years, you're on the hook for paying this, even if you left or even if you drew down your, it goes to what your market share.
So if you weren't there when this happened, you could still get.
Absolutely.
Interesting.
2019 rule change. We did a little mini documentary.
And what's more is that like CEO Evan Greenberg from Chubb got on the earnings call and he said, look, when you have an insurer of last resort that keeps these prices on insurance artificially low, it's not the market price. It doesn't accurately reflect the risk. What it does is it encourages state and local governments not to do mitigation the way they should. They don't enforce the building standards or the defensible space. And it encourages risky behavior from property owners who are getting into riskier areas than they can afford.